Okay. Okay, thank you, Curtis. Hi, everybody. I want to thank you for being with us today. My name is Sharif Abdu. I'm a senior analyst here at Valueline. I am joined today by two other senior analysts, Alan House and Charles Moran. So we here at Valueline, we want to hope that you and your family are staying safe and dealing with this difficult time as best as possible. Today, we're going to provide an update on the coronavirus and its ongoing impact on the economy and the stock market. We will also discuss the actions that Valueline is taking to help our subscribers navigate this difficult time. We will then recommend one stock to buy right now. We will also have a Q&A session after that presentation. And today, we have a special bonus for you. We are going to have a bonus pick. In addition to our one stock to buy, we're going to have a bonus pick right after the Q&A session, so we do hope that you will stay tuned for that. Please note that this presentation will be available on our website, valueline.com, and on our YouTube channel within the next 48 hours. All of our previous webinars are also posted on our YouTube channel. Excuse me. Before I jump into the heart of the presentation, for those of you joining us for the first time, I want to provide a brief overview of who we are at Valueline. We are a New York headquartered corporation that has been providing investment research for more than 85 years. Our flagship product is the Valueline Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and level of risk. The product includes data, information, and analysis on more than 1,700 equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange as well. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much, much more. This service is published weekly, and it's created by Valueline's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. So our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Valueline has no investment banking business with any company, and that includes the 1,700 stocks that are included in this service. Valueline does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. Okay, with that out of the way, let's discuss the coronavirus, the economy, and the stock market. The following content was prepared by Harvey Katz, and he is Valueline's chief economist. So Harvey starts, volatility is the name of the game on Wall Street these days. To be sure, such ups and downs are hardly novel for the equity market. Indeed, 2020 has been a truly turbulent year, with all-time highs set early, a brief bear market following in its wake, and a resumption of the record surge late in the spring. But after a rather orderly advance over the summer, a richly valued stock market has been bouncing around, with alternating sell-offs and rallies very recently. There are reasons for this frantic action. For one thing, the records set in July and August had left many equities, especially in the technology sector, at unsustainably high levels and in need of some correction. In addition, COVID-19 remains problematic, with death projections rising as schools and colleges reopen and flu season approaches. This is taking place with no vaccine for this disease yet approved. And finally, a contentious election is drawing near. The rhetoric from the candidates is getting more heated, and the respective economic policies advocated reflect sharp differences. Investors who abhor uncertainty are understandably on edge. Meantime, the economy continues to push ahead gingerly, providing some stability which is rather reassuring. To wit, key reports, whether showing modest improvement, such as the industrial production, or proving to be a bit disappointing, continue to project a partial recovery in the final half, with GDP, which tumbled in the second quarter, likely rebounding off that low base in the current and concluding stanzas of 2020. The Federal Reserve remains another positive factor, with the bank leaving little doubt in its committed actions to an accommodative monetary policy, highlighted by low interest rates and a readiness to inject further large sums in support of the ongoing economic recovery. Meanwhile, things may get more unsettled before they calm down, and the likely reasons are continued elevated valuations, especially among some well-known tech names, and the upcoming election. So, even though long-term investors should remain committed to equities, given the support of some fundamentals, the road ahead still may be bumpy. In conclusion, we think maintaining a healthy position in stocks is a prudent strategy, especially as long as the economy and earnings remain supportive and interest rates stay low. So that was a commentary of our chief economist, Harvey Katz, his economic view. And with that out of the way, I'm going to discuss a little bit more about Value Line and our one stock to buy right now. So Value Line is providing a great deal of information and analysis to help our subscribers. We know that most of our users depend on our weekly stock reports, time-tested ranking systems, and other valuable services. In addition, Value Line provides a great deal of daily content that can help you avoid the pitfalls and profit during this volatile time in the stock market. Every business day, senior members of Value Line's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data and information that may change our view and investment recommendations for specific stocks. When something noteworthy does cross our desk, we immediately publish a supplementary report that outlines the new information and, more importantly, what it means for the stock and for shareholders. This content is posted throughout the day on our website. Again, that's valueline.com. I will now show you how to access it. Okay, I'm going to share my screen. Fingers crossed this goes smoothly. Okay, we're in business. So right now I'm on the Value Line homepage. Well, actually, here's the Value Line homepage. Okay, and the way you would access it is pretty straightforward. You would sign on with your Value Line, your login credentials, your username, and your password, and it would take you here. This is the Value Line, sort of the landing page for our website. Once you're on the dashboard, that's where I'm located right now, the dashboard. If you can see with my cursor right here, we're on the dashboard. This is the main landing page for subscribers. Under the quick links, you can click on all this different content that we have here. You have supplementary reports, you have summary and index, selection and opinion, and it's all created by our professional staff of research analysts. So we have also been aggressively adjusting our financial strength grades in the past several months. Individual companies are dealing with sharply reduced demand for their offerings and supply chain problems, among other issues. Consequently, corporations have been implementing cash-saving initiatives such as headcount reductions, the slashing of advertising budgets, and in some cases reducing or outright eliminating their dividends. Taking on additional debt has also been popular as a means to build cash in anticipation of difficult times ahead. Due to the rapidly deteriorating balance sheets, Value Line has been reviewing and altering our proprietary financial strength grades for the stocks in our coverage universe. These changes are posted each week in our selection and opinion newsletter. And since there were so many changes recently, we have emailed out the list to our subscribers each Monday. For those of you who don't know, financial strength along with price stability, another proprietary Value Line measure, are the two metrics that are used to calculate each stock safety rank, which our safety rank is sort of an aggregate, it's an aggregate metric. It sort of combines all the different factors that we consider about the company's, the quality of the stock and the quality of the company. For more information in regard to our proprietary ranks and ratings, Value Line provides a user guide that can be accessed via the investment education section of our website. Lastly, this is a good time to mention that the case for individual stocks is quite strong over broad index funds. Certainly, particular industries and sectors will recover more quickly than others during this and after this pandemic runs its course. Now, with that preamble out of the way, we will go into the screening process. We'll give you a little introduction to the screener, and then we will select one stock to buy right now. So from where I am now, if you can see my cursor moving in circles here, you'll click on to Find Ideas. Hamster's running on the wheel. Okay, there we go. So from here, you'll see a lot of different things that you can choose as far as sort of trying to find a good starting point for investment ideas. You have we have a special product for ETFs. We have portfolio trackers. We have dividend income and growth, which is a select portfolio of stocks that are geared toward individuals that want to sort of prioritize dividend or income generating stocks. And as well, you'll see here where I am right now is the screener. So we're going to go ahead and click on that and get started on the screening process. Okay, so there are actually a number of different ways you can go about this process when you're trying to set up your own personalized screen. Some people like to start with sort of qualitative measures. For example, if you follow me here down the page, we can start with the ranks and ratings. A popular place to start is with the safety rank or with financial strength. Another way to use as a starting point would be valuation measures. So for example, you see here valuation ratios. You can start with a dividend yield. You can start with the current PE. Another way to go, which is a way that I sometimes like to go when I'm just trying to create a starting point for creating a screen, is I actually like to start with the Value Line preset screens. So if you click down and you see a drop-down menu here shows up with all different Value Line preset screens. We have small cap stocks with above average yields. We have high dividend paying, dividend yielding stocks, lowest PE, highest PE, et cetera, et cetera. Today, what we're going to do is start with timely stocks in timely industries. We want to look at the stocks that we project will be the best performers in the next 6 to 12 months, and we're going to dovetail that with the industries that we think are going to be the best performers in the next 6 to 12 months. So for those that aren't familiar, Value Line currently has 95 different industries that are included in the Value Line Investment Survey. So what we're going to do today is we're going to include stocks that are ranked a 1 or a 2, and we're going to include industries that are the 15 industries that we think are going to be the best performers in the next 6 to 12 months. So out of the 95 industries that we cover, we want the 15 best industries that we think are going to be the best performers relative to the market in the next 6 to 12 months. So I'm just going to take this drag it over. And as you can see already, so we started with 5,700 different stocks. Okay, so that's 5,700 different stocks in Value Line's database. Already just using these two measures, timeliness ranks of 1 and 2 for the stock, and industry rank of 15 or better, we've already narrowed that list down to 123 stocks. So we've really whittled down that list already. For those who aren't familiar, I'll just explain a little bit about our timelapse ranking system. It's based on our projections for share price movement in the next 6 to 12 months, and it's ranked on a very simple scale. As you can see here, if you follow my cursor, it's a very simple scale of 1 to 5. 1 being the stocks that we think will be the best performers relative to the broader market, and down to 5, which are the stocks that we believe are going to trail the broader market in the year ahead. A stock that's ranked at 3, it's kind of a average, neutral. We think that a stock ranked at 3 will most likely mirror the market in the next 6 to 12 months. So at this stage, I'm going to add another set of criteria just to narrow down that list even further. So what I'm going to do is I am going to add, let's see. Okay. I'm going to look at projections. So by projections, I'm talking about we're looking even further out. The first set of criteria I used was for the next 6 to 12 months, right? I was looking at timely stocks, timely industries. That's the next 6 to 12 months. What if we want to look a little beyond that? What if we want to look further out than 12 months? So I'm going to add our projected 3 to 5 year annual % total return. Okay. Now, like many of our screening criteria, you can actually fine-tune this to your specific needs or your specific criteria. So for me, I'm going to set the minimum for the next 3 to 5 years, the total return annualized, I'm going to set it at 13%. So I put in 0.13, and I'm going to put an upper bound of 20%. And I'm going to explain in a minute why you would want to use an upward bound. So now we're going to filter. So we've already cut the list down even further. That's 29 stocks we have remaining. Excuse me. So what is total return? Excuse me. Unlike share price appreciation, total return also factors in current income that would be generated over that time period. So typically that would be generated through dividends paid to shareholders. Now, I'm looking at total return, not share price appreciation. And I set my lower bound at 13%, and that's every year for the next 3 to 5 years. I chose my upper bound at 20%, or 0.20. The question you may be asking yourself right now is, why would you want to use an upper bound? The reason is, by setting an upper bound, you're sort of separating the wheat from the chaff, if you know what I mean. You're sort of a stock with, okay, it has 50% annualized total return every year. Okay, that sounds wonderful, 50%, that sounds great. That probably says something about the quality of the stock and the quality of the company. Your blue chip stocks, your really well-capitalized, well-run companies typically won't have these kind of outsized total return potentials or price appreciation potentials. So by setting an upper bound, you're sort of separating companies that may be a little bit more speculative, right? We want to get them out of the way because right now we're just looking at high-quality stocks. Okay, so we've chosen our projections for the next 6 to 12 months and the next 3 to 5 years. So let's take a look at some qualitative measures, okay? So we're going to add another layer to our screen. And under the qualitative measures, you would just scroll down here to, if you can follow me, ranks and ratings. This is the area where you would find things like the safety rank, timeliness rank, financial strength, earnings predictability, etc. So today, we're going to start with the safety rank. And we're going to set that at stocks that are ranked a 1 or a 2. Okay, so there are loads of risk measures out there and several that Value Line offers. And the safety rank, again, similar to the timeliness rank, it's a pretty simple scale of 1 to 5. with one being the most conservative issues. Okay, so right now we want to highlight the stocks that are ranked favorably for safety and have in the past held up better than most stocks during corrections and downturns. The thing about stocks that are ranked 1 or 2, sort of your higher quality issues, they also meaningfully participate in up markets. So not only does it provide you some downside protection when the market has a correction or a downturn, you also get to participate when the market is up. Okay, so that's the really nice thing. Those good quality stocks, those well-capitalized, really good blue chip companies, they tend to do well whether the market is down or the market is up. So as you can see, we use the safety rank of 1 or 2, and now we've got it down to 7 matches. So we started out with 5,700. We've whittled it all the way down to 7. So I'm going to add another level of security. Okay, we just added the safety rank. I'm going to add another level of security. And one of my personal favorites is financial strength. So as I touched on earlier, loads of companies have been reducing headcount. They're taking on more debt. They're reducing or outright eliminating their dividends. So although financial strength is already a factor in the calculation of safety, I'm just doubling down. Okay, I'm going to go ahead and add financial strength in addition to our safety. Now, financial strength is on a 9-point scale, 9 steps or increments, starting from A++ all the way down to C. And obviously A++ would be the best, and you're going down the scale from there. So today we're going to include stocks that are ranked A++ or A+. And we've gotten it all the way down to 5 stocks. Okay, I think we've gotten our list down far enough. I think if we add any more criteria, we'd basically be left with maybe slim pickings at that point. I am going to add one last criteria. I'm just going to add the cherry on top here, add one more criteria and see what we get. So we've used projections, right? We used the timeliness ranks and we used our 3 to 5 year projections. We've used some qualitative ranks, safety and financial strength. I'm going to add one valuation rank or one valuation measure. So this is the valuation ratios. And we have, as I touched on earlier, we have a whole host of different things that we can choose from. We can use PE ratio, we can use the dividend yield, earnings per share, etc. I'm going to use the dividend yield. Okay. Now, I'm going to set my lower bound at a dividend yield of 1.5%. Now, with dividend yield, you don't have to worry so much about the upper bound because the dividend yield, they tend not to get too out of whack. So I'm going to set my lower bound at 1.5%. I'm going to leave my upper bound at, whatever. It can be undefined. That's not as important. And let's filter and see what happens. Okay, so we had 5 matches before I added the dividend yield, and we still have 5 matches even with the dividend yield. So it didn't really change our list. So as you can see from the stocks that we have left, we have Oracle, CVS Caremark, Comcast, GlaxoSmithKline, and Verizon Communications. So these are really large, well-capitalized companies with long track records of steady performance, steady increases to the payout, very rock-solid companies. So for today, I am going to pick Comcast. Let's take a little closer look at Comcast. Oh, and I'm sorry, I'm going to go back here for a second to our screener. I forgot to add something. Oh, never mind. One thing that you can do when you're finished with your entire screening process, you can see this button up here, Create Saved Screen, and you can save the screen that you just created. If it's something that, you like the results of the screen that you just created, you can click Save, Create Save Screen, and you can name it whatever it is that you like. You can name it, timely stocks, safe, decent dividend, or, you can come up with any name that you want. rather than going through that whole process again, I'm going to go ahead and select Comcast Corp from our menu here. I won't have you sit through me talking that much longer. Okay, so as you can see from looking at the Comcast, this is sort of our homepage or the landing page for Comcast. And it's sort of like a digital report. We have our PDF reports, which are, actually printed every week. But this is sort of like a digital report, and it gives you an overview of the company. We can see that right now the share price is $46. The dividend yield is 2.03%, yada, yada, yada. 3 to 5 year target price range, 70 to 85. So it gives you sort of a basic overview of the company. Safety rank is 1, timeliness is 1, financial strength is an A+. So this, you can think of this as sort of the landing page or the digital page for Comcast Corp. And every company under our coverage has a similar page that sort of gives you an overview of the company. So what I'm going to do is click on our PDF reports, and let's click our most recent report for Comcast, and allow me to make the page a little bit larger so that everybody can more easily read it. So I'm sure most of you are already familiar with Comcast. It's a well-known company. It is the largest cable TV provider in the United States. It's the owner of NBC Universal, which includes TV networks such as NBC, Bravo, USA Networks. It owns film studios such as Universal Pictures, and it also owns theme parks and resorts such as Universal Studios. So if we take a look at our top label here, this is the banner. See Comcast, the name, and then we see the recent share price, which I'm highlighting right now. So we can see that the stock is recently trading at about $45 a share. Now, if we also look at our 3 to 5 year projections, which I'm highlighting right now, we see that the share price, based on our projections, is going to be somewhere between $85 and $70 per share 3 to 5 years from now. So the stock still has ample room to run, right? It's not outsized returns, but it has ample room to run and very healthy annualized total returns. If we look at the statistical array for the company, and that is this section here, I'm going to go ahead and highlight that. This whole area here, that's our statistical array. All this blue stuff here. So what is the statistical array? Everything prior to this current year is considered our historical array. This is the company's historical performance in past years. So here we can see revenues, we can see the operating margin, net profit, long-term debt, working capital, shareholders' equity, et cetera, et cetera. So it gives you a nice overview of the company and its historical performance. But here, from this year and going forward, these are our estimates. This is our estimates array. So these are our projections for the company's future performance. So as you can see, the company, if we look at 2020, is a pretty good chance that revenues and earnings are probably going to decline this year. So if you can see 2020 earnings, $2.40 a share, whereas 2019 was $3.13 a share. So why would that be? Well, COVID happened, obviously, so there's been some COVID-related closures of film and TV productions, as well as their theme parks have been closed. However, we do expect the top and bottom lines to recover next year. If we look here, we expect revenues to not only recover, but actually eclipse the all-time high that was set in 2019. So we expect revenues to rebound about 9 to 10% next year, and we expect earnings to jump a little more than 25% next year. Won't quite reach the all-time high that was established last year, but it's going to recover most of the ground that was lost in 2020. Another good thing about this company is it's not solely reliant on its cable TV operations. They are pretty well diversified. They do have, like I said, their ownership of NBC Universal. They have TV networks. They have film studios. And in 2020, they're actually on pace to add more than 1 million broadband customers for the 14th consecutive year. So that's a pretty good track record. That's really impressive. 14 straight years of adding 1 million or more broadband customers. Now, if we look over the page here and look at some of the qualitative measures. So here we see the safety of one. We see that it has a beta well below market beta. So there's some defensive characteristics built in there. We'll zoom down a little bit to the bottom of the page, and we see here, if you follow me, financial strength of the company is A+. It also has excellent ranks, really very strong ranks for price stability, perfect 100 out of 100, price growth persistence, 95, also excellent, and earnings predictability, 100. This is the one that really impresses me the most, earnings predictability, a perfect 100 out of 100. That's very hard to achieve, that type of rank. So all told, we think that Comcast's position is quite strong, and the stock is appropriate to form one of the building blocks of a successful portfolio. And it is today's one stock to buy right now. So at this point, we will tackle your questions. Please note that we typically can't answer complex questions about specific stocks on the spot. If you have sort of more in-depth or complicated questions about a stock that we did not discuss today, we recommend that you review our latest report on that stock, and that again is available on our website at valueline.com. At this point, I'm going to turn over the floor to Alan and Charlie and let them field your questions. Thank you.
Hi, thank you very much, Sharif, for your commentary on Comcast. My name is Alan House. I'm an analyst at Valueline. Charlie and myself will be addressing some of the questions that you guys had. The first question that I saw was by someone named Julius. They were looking to find out what the meaning of the timeliness rank is, and also how it varies from the total target price range. And that's an excellent question. And Sharif noted in his commentary that the timeliness rank is based on our expectation for price performance over the next 6 to 12 months. There's many factors that go into our calculation. Some of it's price and earnings momentum, but there are a myriad of other factors that goes in. But that's mostly a short-term indicator for, like I said, the next 6 to 12 months. The target price range is our outlook for the 3 to 5 years ahead, and we roll that out each year. So it's always a 3 to 5 year outlook. That's based not only on our earnings projection for the longer term, but also the equity's PE ratio, or I'm sorry, I should say the company's PE ratio for the long term. So those are the two major factors behind that. So it's good, to look at a stock not only for the short term, but also for the long term, depending on what your investment horizon is. So thank you.
Moran, the question was from William regarding the impact of activist investors on Valueline, and if there was any impact. I guess this is in reference to Trian's reported stake earlier this week that moved Comcast stock in a pretty tough tape. As far as the impact on Valueline, there really is no impact in terms of how we view a stock. If a hedge fund were to come in and take a notable position, to the extent it might affect the price momentum, that would really be the only case in which I believe that would impact Valueline's view. Obviously, it is at the discretion of the analyst if it is noteworthy, but apart from that, there really is no impact on the Valueline page from an activist investor.
Thank you, Charlie. The next question I had, someone, I think it was Monica, was asking for the difference between the financial strength and the safety rank. That's an excellent question as well. The financial strength is based on the company's finances, their balance sheet, their cash flow, how much debt they have, things of that nature. So that's for the company itself. The safety rank relates to the stock. That relates to how, other factors, including like the beta of the stock, the price stability, and so on. They generally go hand in hand. Like a company with a higher financial strength will likely have a better safety ranking. So generally a company that's A++ will have a safety rank of 1 or maybe 2, whereas a company with a slightly low financial strength will have a slightly lower safety rank. But it's basically the stock compared to the company. The financial strength is based on the company's financial attributes, whereas the safety is based on the stock. So thank you.
I have received another question from I guess it's Richard here, talking about the price range of the stock and what the range was for this year. As you can see at the top of the page beneath the banner, there are numbers that are parallel to the target price range on the right, but in each column at the top of the page, you will see 2 numbers. One is the high for the yearly price. Thank you for highlighting that. In this case, Comcast, the low price was 31.7 so far this year, and the high price was 47.7. And again, that's for a calendar year.
Thank you, Charlie. The next question that caught my eye was from Clifford. He asked, what strategy does Value Line recommend for the upcoming short-term volatility? And as Sharif noted in his commentary, there are a lot of extraneous factors with the election, with, COVID, with numerous other factors that, that could produce some short-term volatility. That's one of the reasons why we picked Comcast. It has a safety rank of 1. It offers a pretty good dividend yield. As Sharif also noted, the price stability and the earnings predictability, the price stability of the stock and the earnings predictability of the company, as you see in the lower right, are excellent. In fact, they're 100 out of 100, which is top notch. So in this, what you may call an uncertain environment in many ways, we think a safer holding as such as Comcast is a good pick in this environment. Thank you.
I got another one, Alan. This one is from Maurice. It's a bit of it is a different topic, but he was curious to know about where to look for the cannabis stocks that Value Line is looking at. And the reason I took it is that they just premiered. We have an industry coverage report this week. At present, we have about 7 stocks, I believe. The predominant Canadian ones, including Canopy, Tilray, Kronos, I believe GW Pharma as well, and we are considering rolling out more, but that debuted this week. Let's see, scrolling down here again. Alan, do you see any off topic here?
Yeah, I actually saw one earlier. It related to how you can screen for a specific industry. And yes, Value Line does offer a way to screen for a specific industry. So you can, see how a stock compares to other stocks based on the different metrics within a specific industry. That is also part of our screener. That's one of the dynamics of our screener. So I just wanted to point out that is also an option.
Okay, I just saw another one. Hold on, Alan. That was basically regarding the impact of Netflix on Comcast. And I thought, obviously, that is a relevant consideration for Comcast as it pertains to NBC and Peacock, with which they compete. But the question regards the impact in terms of the quantitative rank and or the safety rank, and really that is not going to be reflected in those ranking systems. Those are quantitative to the extent that it is a factor, and it's obviously a very important consideration. The analyst would address that and incorporate that into his earnings estimates and his projections, and that is where you would see the reflection of a fundamental factor more so. I guess indirectly it would come about from the timeliness ranks and the safety ranks interpretation of the estimate and the projections that the analyst had made in part. Alan?
Let me just scroll down the list, see if anything else jumps out at me. I don't see anything at present. Charlie, if you have any others, I don't see anything that jumps out at me.
Yeah, I don't see any further questions. I guess we'll take it to the bonus pick, so to speak. Sharif?
That sounds good, Charlie. If you want to go ahead and talk about that a little bit, I'll get out of your way.
Yeah, sure. In addition to recommending Comcast, which we think would make a fine holding for most investors, particularly those who employ a conservative strategy, we also wanted to provide a stock that may offer a bit more upside, albeit with more risk. And after evaluating our coverage universe and conferring with a group within the research department, we like the prospects of Ingredion Incorporated. The ticker is INGR. Ingredion, which was previously known as Corn Products International, is one of the world's largest corn refiners. It manufactures high fructose, glucose, and maltose corn syrups, as well as starches, enzymes, and related products. The coronavirus did hurt the company's business. Ingredion experienced reduced sales and weaker demand from the food service, brewery, and confectionery sectors. As a result, the June quarter financial results fell year over year. Specifically, revenues and earnings came in at roughly $1.3 billion and 98 cents a share, respectively. And this represented declines of 13% and 37% compared to last year's tallies. That said, it appears that the COVID-19 disruptions have eased a bit, and our longer-term outlook remains promising. The company is a leading provider of ingredients to several industries with decent growth possibilities, including food, beverage, and animal nutrition, with customers in more than 120 countries. Moreover, additional innovations are quite plausible, supported by a large team of scientists. Another plus is partnerships, such as one set up with Norquin, based in Canada, to globally distribute and market that firm's quinoa flours. Finally, thanks to the solid balance sheet, we anticipate more acquisitions. All told, by the 2023 to 2025 timeframe, we project that earnings will reach $10 per share. As for the stock, it is now trading about 20% below its 52-week high. The price has greatly improved the issue's valuation and thus has created a good entry point for investors. According to our proprietary measures and analysis, Ingredion will achieve a healthy price advance over the next 18 months, and it offers worthwhile 3 to 5 year appreciation potential. A dividend yield of more than 3% is another plus. All told, in our view, Ingredion offers significant appeal. Back to you, Sharif.
Okay, thanks, Charlie. Interesting pick. If you guys don't have anything else to add, I think we're going to wrap things up. I want to thank everybody that tuned in today. And as I said earlier, this presentation will be available on the Valueline website, and that's just valueline.com, spelled exactly as it sounds. And it will also be available on our YouTube channel within the next 48 hours. Thanks again for participating. Thank you, Charlie and Alan. And I think I'm going to hand it over to our moderator at this point.